Okay, let me grab my pen. All right, so this particular chapter looks at credit. And credit basically is, and a creditor is basically anyone who gives us a loan. Okay. Um, and so credit becomes very, very important because over the course of your lifetime, you're going to need to borrow money to buy something. And so what are you going to need to borrow money for to buy something? You might need to borrow money to purchase a car. We talked about that in chapter 5. You might need to borrow money to buy a house or a condominium or a place to live. You might need to borrow money for an emergency that might pop up if you don't have any emergency savings planned. Certainly you're borrowing money for college, which is a little bit different. I'll talk about how that's really different. Okay, no problem. So the concept of credit really is about the fact that at some point in time, we might need to borrow money. Okay, so a creditor is a lender, someone who lends money. And so that's really very important. We actually, this is important because we don't actually, most of us don't have a lot of cash lying around and certain things happen. And so we might need a loan at some point in time. Okay. Certainly, it says here in terms of why we need credit out of convenience. Yeah. But that could be dangerous. That could be dangerous. And sometimes people actually borrow money to invest. Certainly, that's very common in business. Businesses borrow money to, say, expand their operations, put up more stores, and become more profitable. And they figured out that the return on buying those assets and being more profitable is higher than the cost of borrowing the money. Individually, it's a little bit trickier, but definitely we can borrow for certain investment purposes. We're going to be focusing more on the fact that we have a lot of large outlays coming up, things that we need to buy that requires a loan. Okay, but there are, of course, many improper uses of credit, and this is really, the use of credit cards is so ubiquitous in our society. It's just part of the landscape. When you go into some place, they're often asking you to, open up an account with us. In other words, get a credit card with us. And whether that's more of the traditional credit card, which is with MasterCard or Visa or Discover or American Express, a lot of it is store cards or gas cards. You can save 10 cents a gallon if you open up a credit account with us at your local gas station. Or you can save, 25% on your purchase today if you open up our store card at some of the places you might shop. You've seen all that stuff. This is not necessarily the best use of credit. Now, if you're using it to get the discount, but you're going to pay it off right away, that's fine. But a lot of us get into the trap of using credit to buy basic things that we really need to pay cash for. So basic living expenses should be paid in cash. So if you use a credit card to buy those basic living expenses, but you pay it in cash when it's due, all of it, that's fine. That's fine. And some of us do that. I often use cash back cards or points, various things, but to pay it at the end of the month. When it's due, you pay it off, and then you get the benefit of getting cash back. So you actually pay less for some of the stuff that you purchased by having a cash back card. Or you're getting points for other things. So that are important to you. So for me, it's Marriott. I'm a Marriott card member. So every time I use my Marriott card, I'm getting points credited for a free stay at a Marriott. Again, it's okay if you're paying it at the end of the month. It's not okay if you need to use a credit card to meet basic expenses. Then we're back to chapter 2, income and expense statement, right? Maybe your income has to be increased or your expenses have to be decreased because you're running a deficit and you're using a credit card to live a higher lifestyle than you can afford. Credit card also makes it easier for us to impulse buy. In chapter 1, module 1 work, I had to do a consumption analysis paper. And many of you just admitted in that, and I think it's part of the exercise, learning objectives of the exercise is we live in a society that makes us impulsive. We want the reward right now. We want what we want right now, even if we don't have the money for it. Because credit card makes it easier to get what we want right now because we can simply put it on the credit card. And those are impulse purchases. And a lot of you work very hard at your jobs to make your living. And part of the thing I was asking you to think about in that exercise is, is that the way you want to spend your money after you've worked all those hours to earn it? Because we work a lot of hours to actually earn the money and actually just takes us minutes to spend it. And so to think about that, and we live in a society that encourages impulse purchases. And that's part of the problem why people misuse credit. Okay. We often need to borrow money for what we call durable goods, goods that are going to last us many years. So whether that's your car, or you need a new refrigerator, washer, dryer, stove, dishwasher, or whatever you have in your house. A durable good is a purchase of an asset that's going to last for a number of years. I doubt that when you buy a new refrigerator, you're thinking, okay, after this year, I'm going to dump it and get another one. When you buy a refrigerator or a washer and dryer, you're praying to God it's going to last 10, 20 years. That's a durable good. But we often purchase non-durable goods, things that are not going to last very long. Whether that's our clothing. I mean, clothing is not made to last a long time. The industry, the fashion industry and the retail industry is really, they're making clothes to last a certain amount of time before they start falling apart. And they often fall apart on their own. Thankfully, clothes that are falling apart are part of a fashion style now, so you actually can keep your clothes longer. But nonetheless, those are non-durable goods. It's unlikely if you buy a pair of shoes and wear those shoes most days, it's going to last longer than a year. It's probably going to get worn out pretty quickly. That's a non-durable good. Okay, so using credit to buy a non-durable good is probably why it's listed in improper use. This should probably be a cash payment. And one of the other problems with credit is we borrow money to buy these types of things, and then we pay back drips, very, very small amounts called a minimum payment. Excuse me. Minimum payments are often less than 5% of the balance that's due every month. So even if they use 5% as a minimum payment, and you only pay the minimum payment, then you still have this 95% of the balance that's going to earn interest over the next month. So minimum payments can be problematic, very, very problematic, because when you're paying the minimum payment, they take the interest out first. and then they apply the balance, which is usually very little left, to your balance. Then they start charging you interest again. Credit card companies charge you interest every day. Okay, so every day you have a balance, they're charging you interest on that balance every single day. So I wouldn't wait for the due date to pay a credit card. I would pay it as soon as possible, because when the balance goes down, that means there's less interest being charged to you when your balance is lower than if your balance is higher. A lot of people like waiting for the exact due date. But the problem is that all that time they're waiting, interest is being charged on the balance that they have. And so it's very important to know that. Another thing to understand with credit, and I'll ask you this in general, and this is not in your book, this is just an Arujo thing. Let's say you make $40,000 a year in income, okay? My question to you, and I'll throw it out there as a general question, if you make $40,000 a year, can you spend more than $40,000 that year? No one wants to answer.
You shouldn't, but you can with credit.
Okay, yeah. So what credit allows you to do is spend more than what you make. Okay, so I want you to think about this. This is a very important lesson. What credit cards allow you to do is spend more than what you make. So let's take a look. Maybe you have a couple of credit cards and you spend $5,000 more than what you make. So you made $40,000 that year, but you spent $45,000 that year. The $5,000 more that you spent was on credit. So the fact that you spent more than what you made, where is this $5,000 coming from? The fact that you spent it this year, even though you didn't make it this year. Well, one thing you have to know about debt, and this is extremely important, is what debt is you're taking your future income and using it today. I think that's critically important for everyone to understand. Okay. What debt is, whether you're using a credit card, whether you have another type of loan, auto loan, loan on your house, is you're taking your future income and you're using it today. Because debt has to be paid back. And it's paid back with your future income. Yes? Would you agree with that? So I need you to connect the dots on this. I really need you to connect the dots with this. Every time you think about using your credit card or getting a loan, there are good reasons to get loans. There's no doubt about it. Debt, not all debt is bad debt or not useful. It can be very useful. But there are improper uses of debt. And the improper uses are just that. You're taking more of your future income and using it to live a life you can't afford today. And if you're using credit cards to pay for food, if you're using credit cards to, pay for basic stuff that should be paid out of your paycheck, like a haircut, right? You're basically taking your future income and using it today. So if you use too much of your future income, what does that mean about your future? Anybody? It just means you have less money in the future to use. So you're guaranteeing yourself a lower standard of living in the future by borrowing too much today. And even worse, as I mentioned in chapter 1, that lifestyle inflation. If you get into the habit of spending more money than what you make, And that becomes a habit year after year after year after year. Whew. What happens when you stop working someday? What happens when you want to retire and your income is going to go down when you retire because you're not working? Boy, you're going to have a really hard time, right? You're going to have a really, really hard time. And sadly, that's what happens. This happens to more Americans than you might think. And you'll read about that in some of the articles coming up, particularly when we get to retirement. It's amazing how many people who are retired, but they're still working because they have to. Because they have to. So it's a pretty sad situation. But just understand what debt is. You're really borrowing your future income to spend it now. So that choice, I mean, again, there are good reasons to do that, and there are not so good reasons. And this is pointing out the not so good reasons. Okay. Rule of thumb, if you do need to borrow money, say for a car, well, that car should outlive your loan. So if you buy a car and you have a 5-year loan on the car, which is 60 months, you'll often see that advertised, a 60-month loan, well, hopefully you're going to be keeping your car for longer than 60 months, you know. And at some point you might basically owe more on your loan than the car is actually worth. That happens too, you know. So you have to be careful about this in terms of when you borrow money, whatever you're borrowing money for, it should be outliving the loan. Watch lifestyle creeping, right? Your lifestyle inflation. The increasing use of credit over time gets us into a habit of borrowing money regularly for things we might not need to borrow money for. Like I said, like getting your hair styled, or like, you know, buying groceries or food. I mean, this is normally things that would be cash. Now, if you're using the card to get cash back and you're paying it off right away, though, that's paying cash. That's okay. But a lot of people just pay the minimum payment and carry a balance. That's not okay. It's really not okay. Remember the purposes of business, right? When you go into a business, they want you to buy from them. Their entire business model is to getting you to buy stuff now. They want to make sales to you. So they don't care whether you're going to pay it later or not. All they care about is selling you stuff. They're going to make it very easy for you to buy it now and pay for it later. And that's why they offer discounts for store cards. That's why they offer all types of fun financing, is because they simply want to sell you the stuff now. They don't care how long it's going to take you to pay it back. And some stores give you really good deals to buy now and pay later, including 0% financing. No financing for the year. Buy it now, don't pay nothing for a year. Well, of course, in New York, you have to pay something. There's still a minimum payment. Because banks are, and credit is regulated by the states more than it is the federal government. Consumer lending is a state jurisdiction for the most part. And so in New York, even if you borrow money on that no money down, pay nothing for a year, you're paying something. There's a minimum payment. But if you don't pay within that year, they charge you interest from the first day you bought it. It's like that year never existed. And they charge you all that year's interest all at once. So it's nice that they give you no payments and 0% for a year. But if you don't pay it within that year, then they start charging you interest from day one, which means that it really wasn't as good of a deal as it seemed at the time. Unless, of course, you pay it within the year. Right. Then it's as good a deal as they say. How many people do that? Less than you think. Again, businesses are not, they're thinking about their bottom line. Their whole objective is to sell you stuff. So they're going to give you good deals. This is personal finance. This is not business finance. I'm not teaching you what's good for the business. I'm teaching you what's good for you. So from a personal perspective, there might be some times when the buy now, pay later can work out. But for a lot of people, it does turn into a nightmare because they let it go. They don't pay it within the year, or they don't take advantage of that grace period, and then they get hit with huge interest costs at the very end. And it's like, what a nightmare. And your book reminds you of that. Excuse me. If you just pay the minimum payment, which in many cards it's 3%, then it would take you a number of years to. So even if you just borrowed $1,000 and you paid the minimum payment of $25 or what have you, $30, it would take you 8 years and 8 months to pay that back. That's crazy. That's nuts. Which means that in addition to borrowing the $1,000 and paying that $1,000 back, you just paid $577 of interest on that. That's 57% cost of that loan. If you borrowed $3,000 and you simply paid the minimum payment, it would take you 14 years to pay back $3,000, 14 years. And you would have paid over $2,000 in interest. So you would have borrowed $3,000, you'd have to pay back $5,000 in total. Crazy, totally nuts, right? Here, if you had a $5,000 loan and you simply paid the minimum payment, it would take you 61 months, 5 years and 1 month to pay that loan back. You would have also needed to pay over $3,400 of interest. So you borrowed $5,000, but you paid back $8,434. Minimum payments suck. Don't do them. Always pay more. Always. Better yet, again, and you want to get the balance down because the interest rate that's charged, and in this example, they say it's a 15% interest rate on this loan, on all of these loans. The interest is being charged every single day you have the loan. So if you're only paying the minimum payment, your balance is staying high. And that high balance is getting charged interest every single day. And as you see, for the banks, it's a profitable product. The interest that you pay is their revenue and ultimately part of their profit stream. So it's a very profitable product for a bank or a lender to lend you money. Okay. It's not necessary, so it's in their interest to make sure you have loan options. It's not necessarily in your interest, right? You have to look at all the sides of a business transaction that you're involved with. What's in it for them? What's in it for you? And for lenders, interest is what they're interested in. Excuse the pun, but I make puns all the time. And these are very profitable products for them. Imagine if you loaned $1,000 and you got back $1,577. It's a profitable product for you. It's profitable. Okay, it's a lot of money to be making. A lot of you are on the younger side and are looking to establish credit. And I just by a little bit of a thumbs up, thumbs down type of thing. How many of you by a thumbs up already have a credit card? So a lot of you already have credit cards. Okay, some of you don't. All right, so a couple of things that you need to know to get a credit card. You need both a checking and a savings account at the bank. We pay all of our bills with checking accounts. We do not pay bills with savings accounts. They want to know your checking account number, And that's important. If you are clever enough to get a credit card, oftentimes, I mean, at least many years ago, the easier cards to get were like gas cards. So if you always go to like the same gas station and it's Sunoco or Shell or Exxon Mobil or whatnot, sometimes getting a gas card there is one of the easier cards to get. Back in the day, my first credit card ever was Sears, because Sears would have given anyone a credit card as long as they had a pulse back in when I was young. It's a little bit tougher when you're dealing with a formal MasterCard or Visa. Um, they they need a lot more information about you before they give you a card. But if you have no credit at all, don't think that you can't get a MasterCard or Visa. What you probably need to get is a prepaid card. In other words, a secured line of credit. So you put like a savings deposit down, say $500 savings account that you open up with that company, that bank, and that they hold while they give you a credit card for $500. And that's called a secured credit card. And those are easier to establish than a lot of other credit cards, than a pure credit card. Because a pure credit card is based on your promise to pay back. So you're going to need a credit score. If you have no credit, you don't have a credit score. Remember, the word credit means loans. If you've never had a loan, you don't have a credit score. Because all a credit score is about is how good are you paying back your loans. That's really all a credit score tells. High credit scores simply mean you're really good at paying back your loans. And so you're not very risky. If you get a loan, the chances of you paying it back are great. Folks that have lower credit scores and lower and lower and lower credit scores means that they don't always pay back the loans that they get. And so it reflects in their credit scores. The lower that credit score, the more risky it is, because if you give that person a loan based on their history, they don't always pay it back. And if you're a business whose business is giving loans and making that type of money on loans, you're not interested in giving a loan to someone who's not going to pay it back, because you don't make money that way, right? So your credit score becomes very, very important. But again, if you don't have one, it's because you have never had a loan. That's what credit means, lending. So to establish credit, again, you need that savings and checking account, both at your bank. If you get a card, the easiest cards to get would be the secured credit cards, which means you're opening up an account at that bank for, say, $500 or $1,000, and they're holding that account to secure your credit card. So they'll give you a $500 credit card or a $1,000 credit card, but it's based on the fact that they have your deposit. So it's a secured loan. But once you actually have that and you pay it regularly, you're going to make small purchases. You never, ever, ever want to be over 30% of your credit line. So which means if they give you a $1,000 credit line, never, ever borrow more than $300 of that $1,000 that they gave you. Okay, because anything people that carry balances that are 30% or less of their credit line have the highest credit scores. They have the highest credit scores, and you'll see that. I'll show you some examples of that. So again, you want to make sure that you can get a card, but before you do apply for one, you need a savings and a checking account. And again, a secured card is the easier one to get, but you need to open up an account there, put some money in it, and they basically hold that as security to give you a credit card. But it's a reasonable way to start if you don't have one. The book goes over the 5 C's of credit. Yeah. Ultimately speaking, they're not going to give you a loan if they don't think you're able to pay it back. Okay. And so certainly capacity is a huge, huge issue. If you have to borrow money to buy something, oftentimes you have to put that something up to support the loan. So if you're buying a house, the house is securing the loan. If you're buying a car, the car is securing the loan. If something is securing the loan, it's collateral. And so when I said a secured credit card, you're opening up a savings account at a bank for $500 or $1,000, and you're basically giving that to the bank. You're allowing the bank to secure that as collateral in order to give you a credit card based on that $1,000. That's a secured card. You basically put up an account as collateral. So there's a lot of other things. Your character is going to be over time. You'll have a history of whether you're able to abide by the terms of your loans, and you'll have different types of loans. So are you able to keep your word in a contract? You know, sometimes you get credit because you have assets. You're worth money. You own some assets value, and you can show that. That's usually a good sign that you know how to handle money. And of course, right now it's difficult because COVID has really affected so many people in so many different ways financially. A lot of businesses aren't doing as well as they used to, and so they're cutting back hours, even closing and getting rid of employees. So the condition on the economy will have a huge impact on whether you get a loan or not, and that's important. So right now it's very tough. So I think having that collateral is going to help you. So getting a secured card is going to help. Of course, one of the things that they look for is, can you handle debt based on your pay? So they look at your credit payments and compare that to your pay on a monthly basis. Okay. You never, ever, ever want it to exceed, I would say 15%. That's or less. So your debt safety ratio, the amount of credit payments you have. So credit, again, loans. If you have a car loan, that's a consumer credit payment. If you have a credit card, whatever that monthly payment is a consumer credit payment. Okay. And you compare that to your take-home pay. That should be low. That should be low. Okay. It doesn't include a mortgage, by the way. It does not include a mortgage on a house. But it includes a car payment, it includes credit cards, things like that. Excuse me. Oh my God. So opening accounts, again, credit, which is lending, is extended to you in a number of different ways before you actually make the purchase of whatever you're buying. Even at different stores, they take some basic information about you if you want to take advantage. Hey, we're at Best Buy. There's this awesome new, TV with the stereo system or a new gaming system. And if I buy it today and I apply for a credit card, they're going to give me an extra 20% off an already good deal. Or if I buy it today and open up a line of credit with them, I'll get 0 payments, 0 interest for a year, and that's what I want. So it's always prior to the purchase that it's extended. They will give you what's called a credit limit, the total amount of money they're willing to lend you, the limit. Again, retailers offer this, and of course, traditional financial institutions offer you this. You'll get a monthly credit card statement. Again, if you can, you want to pay the balance in full so you don't get any interest charges. If you do not pay the balance in full, they go back to the day you bought the stuff and start charging you interest every single day. until you pay it off. So again, credit cards are not always your friends. Most credit cards are issued by banks. Banks issue credit cards like MasterCard and Visa, Discover, American Express. These are cards issued by banks. A lot of retailers have partnered with banks to offer their cards. So you might get a Target card or H&M or Best Buy. Oftentimes those retailers have partnered with banking institutions to provide credit. Again, most credit cards are what we call revolving or open accounts, which means that you can use them over and over and over again, right? So if you get a MasterCard or a Visa for $1,000, well, as long as you use it wisely, you can use it for a long, long period of time. That's not true of a car loan. Once you get a car loan, you pay it back in installments, a little at a time, and you can't borrow that money back, right, for a car loan or things like that. So it's a little bit different. These are open accounts or what we call revolving lines of credit, okay? Oftentimes they come with certain benefits. You can use a credit card to get cash. It's a very expensive way to grab cash, but it's an option. And you can transfer balances from other credit cards to new credit cards if they offer you a better rate. And so you save money because the interest rate that you pay is the price of the loan that you've got. So to lower your price is very important. Of course, they all come with interest rates and they all come with fee schedules. So there are oftentimes what they call teaser rates, advertised rates, 0% for the first 12 months or whatever. Or we'll give you this card for 10% for the year, for the first year before we adjust it to the normal rate. Those are teaser rates. In order to guarantee that the bank keeps its word to give you that teaser rate, you have to you have to pay your card on time. As soon as you break the contract, the deal's off. So if they promised you 0% for 6 months on all purchases, the assumption is you're paying your card regularly on those months. If you miss a monthly payment, the deal's off. The 0% disappears and it goes to the regular rate that they're going to charge you. So just be aware that it's a contract when you're doing this type of stuff. So there are some, there are some cards that have very high fees. They have all types of, this is like, look, fee, right? There's no FIFO and FUM. There's a bunch of fees. So, it's not quite Jack in the Bank stock, but it is a lot of fees. Matter of fact, I think they dress up, on certain days when they charge these fees, and they have a fiesta. How's that? That's okay. That's a party. Fiesta's party. A little bit of Spanish humor. No, okay. But anyway, there's tons of fees associated with credit cards that you have to be aware of. Oftentimes, if you don't pay things in full, or if you don't apply, respect the boundaries of the card, such as the credit limit, the due dates that things are due, they'll hit you with fees. Okay, be careful. Some credit cards give you rewards. Right? I have a couple of rewards. A cashback card is an award card, so I have a couple of those. I also have, like I was telling you earlier, a Marriott-based credit card because it's a Visa. Every time I use it, I earn points for free nights at the Marriott. So there are a lot of cards that give people rewards, and it's just a way to market the credit cards. It's just a nice way to market the credit cards. And so whether you like to fly and go traveling, there's frequent flyer miles, there's rebates on a bunch of different products. And so, that's great. That's really great. Again, I was mentioning earlier these secured credit cards, which means you open an account at the bank, like a savings account, and you put a lot of money in it, and that secures the credit card that the bank gives you. Some banks actually have specific credit cards for students that they offer. So that's another possibility to look into. But I think for the most part, these are going to be the two. If you haven't established any credit yet, those are the ones that are most likely going to get you your first credit card if you need one at some point. Retailers, again, the gas companies, department stores, they have high interest rates. But if you pay them off every month, you're not paying any interest. The problem is most Americans don't pay them off every month. They buy a lot and they keep it for many, 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 many months. So it becomes a problem. Debit cards are not credit cards. Okay. A debit card is linked to your checking account. And so as you're using your debit card, the money is coming directly out of your checking account. That's not a credit card. A credit card is a loan. So when you use your credit card, the bank who issued you the card is forwarding the money to the merchant that you bought stuff at and giving you the bill to pay back later. So a debit card does not work that way. Debit card is linked to your checking account, and so every time you use a debit card, it's coming right out of your checking account that same day or within a day. Okay. So again, there's no line of credit. It's not a credit card. Prepaid cards are basically debit cards. Okay. A credit card is what we call a revolving credit line because you can use it over and over again. Okay. You get a MasterCard with $1,000 credit limit. You use it at this store. You can use it at this store. It doesn't expire unless, of course, you use it so irresponsibly that they close the account. Or you close the account for whatever reason. Then the deal is off. But, excuse me, these credit lines are supposed to be lasting for a long, long time. My oldest credit card is from 1992 that I still use today. And it's basically stayed the same all those years. And so again, these are revolving credit lines. They never, ever, ever have to close. And as long as you use them and pay them back, you can keep using them as long as you abide by the rules of the contract. So, there are, what we call overdraft protection on checking accounts. That's a type of revolving credit line. There are personal credit lines, people that have a personal loan or a personal credit line on the bank. And you can use your house as a credit card. It's called a home equity loan. Not a good idea, but a lot of people have them. All right, so opening the card, it starts with a credit card application. The lender is going to do an investigation, and the investigation is basically going to be based on a few things. One, what's your record of lending? Now, a credit bureau simply stockpiles all your history. They don't really do anything other than stockpiling your history. So they collect all the information about you. What type of information do they collect? Anything that you write on your application. Okay, so if you fill out an application for a loan or for a credit card, and you put down your address, you put your phone number down, your social security number, your income, where you work, blah, 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 all that application information is going to be sent to the credit bureau eventually. So they're going to know all that stuff. And then, of course, if that credit application is approved and you do get your credit card, whether it's a credit card at your local retail store or if it's a Visa or MasterCard, that information is also going to be reported to the credit bureau. And the credit bureau simply just keeps the information about you in a big, big electronic file. Okay. And so credit bureaus basically, and there's three major credit bureaus that your book talks about that we'll get into. And that's really all they do. They sort of just stockpile information about your credit applications and how you're doing. Once you actually pay your payments every month, the bank sends that information to the credit bureau and it gets put into your file. Okay. You should check your file every year, and I'm going to show you a way to do that for free. There are companies that have created what's called basically a credit score. And the biggest company is called Fair Isaac Company. You know them as FICO scores. But FICO, the company's name is Fair Isaac. There's the FI, FICO company. Fair Isaac Company created a algorithm, a large mathematical formula that once they dump the credit report information on, so anything in your credit score, they dump that information into the algorithm, and the algorithm spits out a number. That number is called a credit score. And that credit score tells the lender, it's not really about you, it's for the lender. They sell that to the lender. How FICO makes a living from their credit scores is to sell the credit score to a lender. So anybody who's interested, any company who's interested in giving you a loan is a lender. How do they know they should give you a loan? They buy a credit score. Okay. So they're actually buying a credit score from companies like FICO or Vantage or others. Okay. That's how that works. That's the business of credit scores. And so the credit score is really not about you. It's really about whether you're a good customer to give a loan to. Okay. So I wouldn't take your credit score personally. A lot of people, because credit scores run from 300, FICO scores run from about 300 to 850. And people, oh, I want to be over 800. Well, you know, you need a good credit score. Yes, you should be responsible with your loans. But if I have no debt or very little debt because I don't borrow a lot of money, even if I pay my credit cards off every month, it's going to show a zero balance. I'm going to have a lower credit score than someone who has more debt that's paying it back. Because to a bank or to a lender, someone who keeps their debt open, right, someone who carries a credit balance on their credit card is just more profitable to the bank, right? It's more profitable because they're going to be paying more interest. If I keep paying my bank card off every month, I'm not paying them any interest. So they're not making as much money from me. In other words, I'm not as good of a customer to them as the fact that they're making a lot of money from, my neighbor Joe, who has his credit cards maxed out and paying interest every month. As long as he's paying interest and he's doing everything well, he might have a better credit score than me, even though financially I might be in a better position than him. So remember, the business of credit scores is for lenders to give you a loan or not. It's really, I wouldn't take it too personally if I were you. But that's what the purpose of the credit score is. It's to tell the lender whether you're good for the loan. For the most part, the average credit score, I believe in the US, or we can look this up as well. You want to have a credit score, a FICO score that's higher, that's 720 or higher, to get really good rates, to get good loan terms, which is lower rates on loans. You can get loans if your FICO score, credit score is lower. But if it's lower, that means you're riskier. And lenders don't mind giving you a loan, even if you're risky, but they're going to charge you a much higher interest rate. So the level of risk is reflected in the interest rates they charge. If you have a credit card that's charging you 25%, and your friend has a credit card who's only charging him or her 18%, I think you can assume they have a better credit score than you, because it's reflected in the interest rate of the loan. It's reflected in the interest rate of the loan. So that's something to know about credit scores. FICO is Fair Isaac and Company. I'm going to show you their handout. They actually have a brochure that I'll put up on the site for you as well. But a lot of people want to know how they can improve their credit score. The biggest part of your credit score is paying on time. So if you really, really, really want to improve your credit score, just pay your bills on time. Every 6 months you pay your bill, you're going to get a bump in your score because they usually do it in 6 months intervals. Okay, so after 6 months, you've got a pattern. This person's paid on time for 6 months. Okay, they're a better credit risk now. They've improved. The second thing that they look at is how much you actually owe. It's how much you actually owe. Okay, Clark was saying adding your banking activity could help raise it. Yeah, so you can actually add like paying your rent and other types of stuff to your credit score, and it helps. The amount that you actually owe is the second thing. So if you have very, very high balances, you're more risky. Keep your balances low, below 30% of your credit line, and that'll improve your score quite a bit. Okay, if you're going to have credit, keep it in a credit card, keep it for a while. Again, what helps me is I have a credit card that's almost 30 years old at this point. That helps my credit score a lot. You know. Don't apply for new credit unless you need it. And then, of course, if all you have is credit cards and you don't have an auto loan or other types of loan, that's going to affect because they want to make sure that you're a good customer to the bank or to the lender, which means that you're going to be taking lots of different loans. Again, this is for the business. That's why you shouldn't be taking a lot of this stuff too personally. The overall average, according to your book, is about 700 or higher. But again, the higher that goes, the better interest rates on loans you're going to get. Okay. This is interesting because lenders must tell you how much the loan is actually going to be costing you, what they call the annual percentage rate. Because some loans come with fees and costs. So if you're paying a fee or a cost to get a loan, that's part of the price of the loan, in addition to the interest rate. So that means you're actually paying more than the interest rate that's stated if you have fees to pay as well to get the loan. So all of these are used to calculate APR. Again, I was telling you in the book just shows you that interest is charged daily on your credit card. Daily. Every single day you have a balance, they're charging interest daily. How they actually apply that is they use something called an average daily balance. They look at your balances every single day for that month. They average it out, and they charge you interest every day based on that average. Okay. So be careful. Just be careful. And again, I would try to pay my balance down more quickly to keep the interest rates, keep the interest charges low. Okay. So here's an example of an average daily balance. For the first 5 days of the month, you had a $1,500 balance. So 5 days at $1,500 is this amount here, $7,900. For the next 7 days of the month, your balance increased to $2,332. 7 days of that means what this calculation is. For the next 15 days of your month, the balance was $2,732. 15 times that amount gives you the 40,000 here. And for the last 5 days of the month, your balance decreased. Obviously, you made some type of a payment to $2,457. They calculate all of this. This is the total per day, divided by the number of days, 32 days in this particular period. So the average balance on your account was $2,421, which means the interest rate is going to be applied daily based on that balance for the 32 days. Okay. So if it's an 18% interest rate, and this is a month, so you divide it by the month. So the interest rate is basically 1.5% per month. And they're going to calculate. I actually would take it one step further. They actually divide this into the day. I've seen, that's how I usually see it calculated by the day. And so this particular month would charge you $36 in interest on this balance. Let's say your minimum payment is $50, right? You send in $50. The first $36 they're going to take right away for the interest. The remaining $14 will lower your balance. That's how it works. So just be careful, because that's, it looks like you're sending $50, but you have to pay interest first. Then the rest is paying your balance. Okay. So just be very, very careful. Always pay by the due date. I would say before. If you borrow and you pay the entire amount, you won't have any finance charges, any interest charges. But if you only pay a minimum amount or not the full amount, they're going to go back and charge you interest since the day you borrowed the money. Okay. Always shop for the best deals, clearly. Interest rates they're low, but they're high. We live in a period of time where interest rates are very low in general, but credit card interest rates are still pretty high. And that's because of the risks that are involved in credit. Okay, so I'm going to go ahead and change the screen here as well. Fraud is just one of those types of things. Never, ever, ever give your account number to people who call you. Make sure you use secure internet sites. Don't put your information on checks or other types of things. And make sure that you immediately report any lost or stolen credit cards so they can cancel the credit line. They'll issue another card, but keep yourself safe. You might be on the hook for about $50 of anything that happened. Oftentimes the liability is zero, which is great. But if you don't report it and it's used and used and used over time, you might be responsible for all of it, even though you didn't make it. All right, I'm going to stop the share, bring us back here. I'm going to show you a couple of other things real quick. Okay. First, can everyone see that I have a FICO book open here? Yeah. All right. So first thing is, and I'll put this up here, Understanding FICO Scores. It's a very, very large book. FICO is just the largest company, Fair Isaac, that is used in a lot of lending decisions. And so again, what's important here to notice, they say the national average is about almost 700. If you have these particular scores, you have these ratings. So anyone with a score of 800 or more has an exceptional rating in terms of they have an exceptional use of credit cards. They've always paid things on time. Banks want to do business with you and give you the best rates. But again, if you have scores that are between 740 and 800, you're still very good, above the average. Notice what happens when you get below here. When you have fair credit or when you have very poor credit, it simply goes to, being a risky borrower. And if you're risky, you might still be able to get a loan, but they're going to charge you a lot more for it. And you're going to have more than one FICO score. There are different FICO scores for different lenders. And so there's one specific for car, auto lending. There's one FICO score specific if you apply for a house. There's another score that's specific if you apply for credit cards, etc. So never think you just have one credit score. You have multiple credit scores depending on what you're applying for. They all use different factors. Okay. And again, what this shows is a copy of your, here it shows you a copy of your credit report, showing your overall FICO score is here, information they get from the credit bureaus. So they have to purchase information from the credit bureaus that then they put on their algorithm. That algorithm spits out a score that they then sell to any type of lender or creditor. And FICO does it better than most. And so they are a very, very large company. There are other types of credit scores out there as well. They're just not as popular as a FICO score. Okay, so a lot of people will look at their FICO score. But again, any information you put about yourself is on the credit report. Is on the credit report. Okay. And again, some very, very important aspects to understanding a credit score. I'm going to move this over. Again, 35% of your credit score is about paying on time. The other 30% is the amount of credit you have. If you keep that amount of credit to less than 30% of your credit line, you'll have a higher score. Okay. And if you keep paying every time you pay for 6 months straight, your bills you pay on time for 6 months straight, you're going to get a boost in your credit score, guaranteed. Okay. Look, 2/3 of your credit score are based on those two factors. So for people that are very interested in increasing their credit score, that's what they need to focus on, those two factors. Okay. And let me take you to one more screen. I hope I picked the right one. Okay. You can get a free copy of your credit score. Again, in order to have a credit report, you have to have some type of loan, right? If you don't have a loan, have never had a loan, you won't have a credit report, nor would you have a credit score. But this is the one that's actually set up by the government, annualcreditreport.com. It is the only source that's authorized by federal law. You can request your report. They show you about the reports. You can request your free credit report because there are 3 credit bureaus. There are 3 credit reports that you're able to get. Okay. You can get one every year for free. You can get one every year for free. You simply have to fill out the form. Okay. Fill out the form. Right. So again, this is the only site. The other sites might charge you. You don't want to get to a site that charges you anything. This is the one that was required by law under the Dodd-Frank Act, which was passed by Congress during the crisis of 2008. And it was signed into law by Obama. So this provides you with a free credit report every year. Okay, and this is the actual form that you fill out, okay, to get for. If you see any errors on your credit report, you don't have to hire a company to get you good credit because all they're going to do is fill out a form that you can fill out. If there's any dispute on anything, you can fill that out and send that to the credit card company. They have to, by law, look at it and try to correct it. Okay. And so again, there are definitely ways in which you can get a hold of that type of information. But again, if you've never had a loan, you're not going to have a credit report and you're not going to have a credit score. But as soon as you start applying for loans or getting those loans, you're going to have a credit report. Yeah, there's Experian, which is very popular, TransUnion, and one other one that I can't think of off the top of my head. But there are 3 major credit scores and credit reports. Yeah, I have.
Equifax.
Sorry?
Equifax.
Thank you very much. Yes, that's right. Equifax is the 3rd one. Yeah, I actually have an Experian. I use this oh, my phone. And so they actually have some information regarding that as well. Right there. So you can use apps, other types of things to keep track of some of this stuff on your credit report. It becomes difficult if your name is very common. If you're like, if you're Joe Smith, I mean, there must be hundreds of Joe Smiths in the country. And so it's easy if you have a very common name that there might be something wrong with your credit report because there are so many people that have your name. And so information might have been put in the wrong electronic file. So that's one of the reasons to check it. But if you have a very, very unique name, it's unlikely you're going to have many problems with reports on your credit score. Because the only, on your credit report, because the only way those are reported is when you apply for credit and when you actually get credit and start paying on it. So, so credit's interesting. Again, it's a necessary part of life, but a lot of people abuse it. Right? A lot of people abuse it, and they get into trouble for that. You're going to be reading about personal bankruptcy, and there's a discussion board question on personal bankruptcy that's very specific to that. It's a lot of people think it's because it's too much credit card debt, but as you'll read the report and look at it, actually one of the biggest problems today is medical debt. Medical debt, and that's because even people that have insurance, health insurance, get hit. Their insurance might not cover certain things, and they get hit with very large bills from hospitals and all types of things. So medical debt is a big part of one of the reasons why people are in trouble and might need bankruptcy protection. Okay. All right. Well, I'm going to stop the recording here and just open it up to questions.